All right, so we have the market trading down into a very, very deep discount. If you look at the range low here, why am I not picking this one here? Because this move started there. Okay, that's what I'm looking at, this move. These are relatively equal lows, so I'm just going to move over to the most recent swing low. Why is this a swing low? We have a candle to the left of it that has a higher low than this one, and a candle to the right of it has a higher low than that one. So that's swing low. That one here to here, that's my daily dealing range. Okay, market has recently retraced back down in about 50% equilibrium of that price move. Okay, so that's what we're annotating here. About halfway is what really essentially what's being shown. And also, because of that, the market is likely to create a little bit of a retracement. So because this daily chart has retraced down into about half of the move from that low to that high, so we basically went back to equilibrium, or roughly a short-term what? Discount. Because of that, there's a likelihood that the daily bias is going to be bullish on this day here and this here. Now, we're going to look at this candle because midpoint of this candle, that right there is the mean threshold. Mean threshold is the half point or median of a order block. That right there is rooted on this up close candle. Why am I using that up close candle? Because from this high down into the 50% retracement of that low and high, where the market goes back to equilibrium or short-term discount, that means the bias has a likelihood. Now, folks, listen. You want to be taught about bias? I'm teaching it. Listen. You went down to equilibrium or short-term discount. The next day, we can expect it to go higher. So what do we do with that information? If it's likely to go higher the next day or the day after that, what happens if the next day is down or if it doesn't move? Okay, you go into the next day expecting it to go higher. This, it just so happens that what I outlined on Monday panned out. But that's what I'm referring to every single week. I'm outlining something. This is your premium array. That means it's going to draw up into that. It could be this candle's low because it's the order block, bearish order block. Why should I be concerned about this candle? Because in this move here, right before this displacement on the downside, this was the last up close candle. So you have several targets here. You have the candle low, the open, the mean threshold, halfway order block, and you have the high. The high is the less likely. The easiest is one down here. So on this candle here, when we expect it to go higher, we can see it trade up into that candle's low. We can see it trade up into that candle's body. We can see it trade up into that candle's mean threshold. You're looking for the lowest hanging fruit. Which one's the easiest for you? Now, blending that with the idea of purge and revert. We went down, we took out short-term low, sell side liquidity. See that? Right below here. So we purged sell stops, and it's going to revert back to the high in the last 3 days. So day 1, 2, 3, that's this day here. So this candle's high, it can draw back into. So we have, yes, this order block low, but then we have this idea here where the move dropping down, that high is going to have what resting above it? Buy stops. Why would there be buy stops there? Because traders that are short, they're going to trail their stop loss right there. All right, so we're dropping down into the hourly chart. Market traded down into that short-term low, ran out sell stops here or sell side liquidity. So it purged that liquidity. Then we had all this sloppiness starting the week, and then we dropped down and rallied up. Doesn't look too clean and clear in here, does it? It's okay. It's about to change. We're going to drop down the lower time frame because we have a bias. I mentioned on Monday that I felt that this was going to go higher and clear up all this here. And that was the draw on liquidity. But I want you to look at this hourly chart and just see this movement here to here. See that? You don't have any reference points inside the hourly chart here. That's okay. Do you see how level these two highs are here? This is what I dub relative equal highs. That right there engineers buy stops. So what is narrative? What is that? Well, we have the market trading down into that short-term low, below old lows, about 50% of its daily range. So we purged the sell stops. Where is it going to go? Higher. Why? It needs to go to buy side because it's now collected sell stops. So smart money is going to do what? Offset those buy orders that they used to pair up with the sell stops below these lows. They bought those sell stops. So now they're net long. How do they get out? They have to sell them to willing buyers. But at this point down here and over here, who's going to be buying from them at a higher price? The buy stops that are resting above here. So you have to think algorithmically. How do you pair your orders? If you don't have this mindset going in before you click the enter button of your trade, you are gambling. So the logic is we're looking for it to run above here. And now think about that in this area here. Here's the 19th on Tuesday. Think about what does your daily candle look like if it's going to likely go up here and we're down here. it's going to create what? A little bit of a movement down, make the low of the day, then rally up to clean that level out. And we're not trying to predict the closing price on the daily candle. We're not trying to do that. We're trying to participate in a move in the morning session that gets us long, that allows us to run up into this area here, and that would be your target. So point of origin, terminus. Buy orders on smart money, sell orders on smart money. Retail, buy orders, retail, sell orders. That's the continuum that goes between smart money and retail. You have to change your thought process about what you're looking at in the charts, and that is narrative. Looking for the daily delivery on that candle, Judas Swing, buy below the opening price, expect displacement to the upside, run into liquidity, offset, sell to buyers, move to the sidelines, you're done. Now, what does that look like on a lower time frame? Here's the 15-minute time frame. Here is the relative equal highs, buy side liquidity resting there. Look at this price action in here. What do you see? Pause the video. This is that moment where you want to study and look at it. All right, so here we have this low. Why am I picking that low? Why not that low, Michael? Why didn't you pick this low, Michael? This movement here, this is the most recent swing low. It rallied up and it created a higher high right above these relative equal highs. So there, at 0.1 to 0.2, that's your dealing range. I'm using that because it's the most energetic, most recent low and high. This is where I think the market's going to go up to, because I think all of this movement down here basically has accumulated all the sell stops. So now smart money's heavily net long, and they are sitting on all these counterparty traders that either were knocked out of the marketplace and they absorbed all of their sell stops, or they're caught offside and retail's trying to go lower. It doesn't make a difference. I'm not suggesting that you should even waste any time trying to figure out what that is. I'm just saying that below old lows is sell stops, below old highs is buy stops. Just have it in mind. It's just that simple. Now, knowing that by itself is not enough. You need to know what is likely to occur. Here is the midnight candle in New York, and that's your New York midnight opening price. This is the price I want to preferably be buying below. Now, there are instances where the opening price will be lower, and then the market is trading higher but doesn't go back below the midnight opening price. This is why I said 8:30 opening price. 8:30 is when a news embargo lifts, and a lot of news comes in around 8:30 typically, and I use that opening price there. This is kind of like just a dandy of a setup. It means it's really good. I like these types of setups, what I'm going to show you here. When it delivers something like this, it's almost like it's presenting it to you on a silver platter. Like if you really, really want a good little setup that's going to just be a real nice crackerjack, it just delivers nicely, it's this one here, okay? If we're bullish, the confusion that you're getting about the opening prices at midnight and the opening prices at New York, 8:30 a.m. Last ditch for Power 3 is 8:30. What does that mean? If the opening price at midnight, if you're bullish, is lower than prices trading at around 8:30 or after 8:30, then it's likely it's not going to be a factor. Then you use 8:30. If there is a day like this one here, where we have the opening price at midnight here, we're already below it. And after 8:30, we're below it again, still below the midnight candle's opening price. We're really in a discount. Like we're really, really cheap on the day when we're bullish. Inside this range, it moved from here to here and then started retracing down after midnight. Notice that? So all of this here is a Judas Swing. Judas Swing is the move that's opposite to what you expect the daily range to be. So if we're bullish and we think it's going up here, we like this movement going down. You may not feel comfortable buying the London or overnight lows. That's fine. You don't need to. Wait for 8:30. If we drop below 8:30's opening price, and here's the kicker, we're below the opening price at midnight too, we are really, really oversold. Visually see what's being shown here. Below the opening price, you want to be a buyer at midnight. By itself, that's always the basis of what I'm trying to do each day. Then, if we get a 8:30 candle that opens below the midnight candle, and then we have a movement below that, that move here also is like a micro Judas Swing for the session of New York. This is a Judas Swing on the daily range or the daily candle. So this is basically building the low of the daily candle. This is building the low of the New York session. Both are using the Power of 3 concept, which is accumulation, manipulation, distribution. So what we're saying is this movement below the opening price at 8:30 and below the opening price at midnight, each move lower is the trap. It's the snare that catches traders thinking it's going down. Now I'm down into a 5-minute chart. I want you to take a look at price, study, think about what you see in price action here. Pause the video. Right there. See that fair value gap right there? See these two down closed candles? That's your order block. that's bullish, your fair value gap. And 8:30, we have a drop down. At 8:30, we're looking to the left and see where are our short-term swing lows, because we want to absorb sell stops, because smart money will pair that with their buys. And we're looking for an imbalance preferably, and we just happen to have it also with an order block. So we have a lot of things happening here. It comes down, hits it, and then rallies. 8:30 opening price, we find it come back down into it, find some support, and it springs aggressively above these short-term highs. By itself, that right there is enough. But if you're holding it for the daily range, you're going to wait for it to reach up in here, and it does so here. Now, in this area here, notice what happens. It rallies up and consolidates during lunch. And around the 2 o'clock hour, going to the 3 o'clock, we run back down into sell stops. Traders that have trailed their stop loss up because they don't want to lose any of their profits. And then they pump it one more time up into the PM session or afternoon move into the liquidity that was outlined relative equal highs on the 15-minute time frame. Here is the 1-minute chart. Here is the low forming. And now find the setup that would occur with the YouTube model. So in other words, we're seeing a movement here. The bias is bullish. We're looking for a continuation on the upside. We have a target based on that 15-minute time frame, relative equal highs. What does the model I'm teaching on YouTube, where does that exist here? Again, pause the video. Use this moment to really look for it yourself. Okay, the market has a run above this short-term high. So we have a shift in market structure that's bullish. What's this? Fair value gap. It trades down into it. 3 consecutive down close candles. That's what? Your order block. All consecutive, because we're looking at 1-minute candles. That is the order block with a fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price, opportunity again. Trades up into the New York midnight opening candle. Trades back into another gap. Trades into the midpoint of that. Rallies up, consolidates, and then expands up into our objective that was outlined in that 15-minute time frame, the relative equal highs. Now let's dig a little bit deeper. Notice the price low here. Now what I've shown is the daily chart, but on an open, high, low, close bar. Now this opening price is not the midnight candle opening price, because you can see it's about, 44.04 and a half or something like that. That would be just above where this opening price is. So my opening price is just a little bit above this opening price. So I'm not using the opening price on the daily chart on TradingView. You can, there's nothing really inherently wrong about that, but I don't personally do that. So that way, for clarity and continuity, I don't use the opening price on the daily candle. I physically go into my chart and use the opening price at midnight. Once that candle begins trading at midnight, that's your opening candle. And same thing for 8:30. So the relative equal highs on that 15-minute time frame is basically this candle's high. So this short-term run below this short-term low is taking all the sell stops on that day, on the 18th. So if we look at what we've done over here and how this fits the daily candle, what I'm suggesting is that my opening price, because at midnight we're a little bit higher, and I don't need to catch that very, very short-term low that's lower than this one. This is the reference point at which my methods would see as an entry point. So that's real close. That's like right in here. That's real close to the low of the day. I don't need to have the low of the day. You don't need to have the low of the day. But when you get to the New York session opening at equities 9:30 in the morning, New York time, this run in here, that sets it up. Another opportunity here. So we have optimal trade entry here if you want to trade the OTE pattern I teach on the YouTube channel. And then it rallies up. And then you're running all the way up the daily range until we get to this candle's high here, which is the relative equal highs on the 15-minute time frame. So what's occurring here is what? It's purging sell stops and reverting back to the high in the last 3 days. But the main thing is you're looking for an opportunity to anticipate the expansion of that daily candle in one direction or the other, either higher or lower. And in that direction, higher or lower, where's it likely to go? And the easiest thing I teach is old highs and old lows and relative equal highs and relative equal lows. Those two ways of looking for pools of liquidity are the easiest, most visual representations of targeting, because old highs right above that is always going to be buy side liquidity. Buy stops are going to rest above that, and below old lows there's sell stops resting below that. It's always going to be that way, folks. It always will be that way. They're not changing anything. They can't change it, because that's the way these markets book. The sky's blue. Not all the time, but the sky is blue. The grass is green. Not all the time, but the grass is green. You follow what I'm saying?